Hello again. I wanted to take this opportunity to discuss the comparables approach to valuing either a firm, or more specifically, we've been valuing the market value of equity for firms. The comparables approach is really what I call a multiples approach. And so you calculate the multiple, and that's usually a multiple of earnings, different definitions of earnings. So the idea would be that you would calculate the earnings multiple of a firm that is similar to a firm that you're interested in valuing, and so it should be have similar risks, similar growth opportunities. Ideally, would have similar debt equity ratio, those sorts of things. That doesn't mean that it has to be the same size firm or have the same number of shares outstanding or anything like that. You just need to make sure that you've thought about that the firm you're talking to can reasonably be considered comparable to the firm that you are going to value. So the one that you're going to use as the base and calculate the multiple for needs to be similar to the one you're going to value. Then you're going to determine your multiple, and once you have that multiple, you're going to get the earnings for your firm, and maybe, depending on which approach we use, the number of shares outstanding. And you're going to apply that multiple, and that's going to allow you to estimate the value. So the logic behind this, and the textbook I think describes this as well, is very similar to what's used in real estate and for cars and things like that, which is if I know that a particular asset, let's call it a house, has recently sold, and the characteristics of that asset are that it's in the same neighborhood as a house you own and want to know the value of. It has the same number of rooms, bathrooms, garages. It's about the same age. They don't have to look exactly the same, but they can be close enough, let's say. Then you could probably use one as a good estimate of the value of the other. You could take this a little step further to be similar to this multiple by saying, let's say that all of those things are similar, but your house is a different size than theirs. You could determine from theirs what the value per square foot is, and that becomes your multiple. You multiply that by the number of square feet in your house to get your house. And so that's a common thing that is done in real estate. It turns out that there's a similar type thing that is done in valuing firms. So the two most popular earnings multiples that are used are the PE multiple and the enterprise value to EBITDA ratio, or the EV ratio. And so with the PE ratio, P stands for price, meaning your stock price. E stands for earnings. In this case, usually use earnings per share, and because you do that, you have to take one extra step. So the stock price could be the current price, or maybe some average of recent prices if your stock price has been very volatile. Ideally, we like looking at forward-looking earnings. That's what would make it most consistent with the derivation that you can do from the discounted earnings model to the PE ratios. But it actually doesn't care, and a lot of times people prefer trailing earnings because they're concrete and there's no guesswork in them. As long as you're using the same thing, so if you use trailing earnings to calculate your multiple, then you need to use trailing earnings in the firm that you want to value. There should be no problem. This is particularly true if you think both of those firms are going to have earnings growth at similar rates, because that means that if their trailing earnings are the same, then their forward-looking earnings should be about the same in terms of their growth rate. So the other ratio or multiple that's often used is the EV/EBITDA ratio. EV is enterprise value. Enterprise value is the market value of equity. So you'd go out and get your market cap plus the market value of debt. So you would figure out for any debt that's issued by the firm what it would cost to retire that debt, and that's the market value of that debt. And so you would add those two together, that's enterprise value. If you went out and tried to do that piecemeal, that can be challenging because it's really hard to find the market value of debt for firms. That information is just hard to get. Luckily, there are a bunch of research firms that keep up with this stuff, and so quite often you can just find the enterprise value. They've already combined the two numbers and they keep it up to date, and you have all of that. EBITDA is earnings before interest, taxes, depreciation, amortization. That's what you would expect it to be. There is a variation on this. There are some people that like using EBIT in the denominator instead of EBITDA. So they exclude interest and taxes, but they go ahead and put the depreciation and amortization. The author of the textbook makes an argument for why one is better than the other. I'm not going to make you grasp or understand that argument. What I can tell you is this EV over EBITDA ratio is the one that you're most commonly going to see cited and have presented to you. So that's the one I want you to focus on. If you go out and look in the marketplace, you look on Yahoo Finance, any of those sorts of things, that's the ratio you usually see. So I'll give you kind of a quick example of that. And I'm going to use Disney. In this case, we're not valuing Disney. Rather, Disney's going to be the comparable firm. We're looking at a firm A. Let's say it's similar to Disney. It's a similar industry, has a similar beta, similar earnings growth assumptions. I use the beta as a proxy for that it has similar risk. And let's for now just assume that it has similar debt to equity ratios. The big difference is that firm A is not nearly as big as Disney. It has trailing earnings of $3. It doesn't even have forward-looking earnings because it's too small for that to be an issue. And rather than having 1.59 billion shares of equity outstanding, it has 1 million shares. So the first thing we would do is we'd calculate the PE ratio for Disney. We have a future earnings and trailing earnings. We know the share price is about $108. Future earnings 6.65, trailing earnings 5.93. Again, we got those values off of Yahoo Finance. You can see that in separate videos earlier. And we're just going to plug those into a spreadsheet that I've created. We'll drag it over here. There we go. Oh, forgot. Got to do this first. There we go. All right, so we're going to drag it. We're going to put the spreadsheet over here. That's an interesting effect. Here we go. And so $108 a share. Here's our earnings per share. And all I did was take the price divided by each of those earnings. We get two different PE ratios. We want to know which of those PE ratios to use over for firm A. Well, firm A only has trailing earnings, so we'll use the 18.21 with it. And when we do that, we're going to go down here and calculate, well, we're going to go up here, I guess, and calculate the price as just $3 times 18.21, right? And that's $54.64. And so that's quite simply what you do. Now, if you wanted, instead of the share price, the full equity value, you then multiply it by the number of shares. We have 1 million shares outstanding, and so for us that's $54,640,000, and that becomes the value of the equity of the firm. So all that's spelled out over here for you again, but should line up to that. Now, using Disney again, we'll do a EV versus EBITDA ratio example. So assume you wish the value of the firm. Again, everything's similar. In this case, the EBITDA of the firm is $6 million, so we got to use EBITDA instead of earnings. And since EBITDA is before you take out interest, taxes, depreciation, amortization, then usually for a firm that's profitable, you expect EBITDA to be bigger than earnings. So we're just going to say it's $6 million. I just made that number up as an example. So first we calculate the expected value or the enterprise value. And again, I'm going to go back over to my spreadsheet. We go calculate the enterprise value or get the enterprise value for Disney. 187 billion 530 million is what that is. And so that you know, got that off of Yahoo. If you go look under their statistics, you can see enterprise value listed right here. They actually do an enterprise value EBITDA calculation. Like I said, it's a very common one, so you could just pull that. The EBITDA is down here at 16.99 billion, so we would put that in there again in millions. That's 16,990. Sure enough, when we calculate, it gets the PE ratio of 11.04. So we're going to take that times our $6 million, or excuse me, $6 per EBITDA. $6 million. Did I say that right? Yes, $6 million of EBITDA. And we're going to come up with a enterprise value of 66,230,000. So right off the bat, you see those two are different. Now, don't panic, because enterprise value is the value of equity plus debt. And so you would expect that it's no smaller than this, and if the firm has debt, it's bigger. Okay, so not necessarily the case that those two came out inconsistent. They're just looking at a different value. So, sure enough. So let's talk about just the two and when you can use them. The PE ratio, again, gives the value of equity, not the entire firm. Importantly, it assumes that the firm you want to value has similar to debt to equity ratio as the one you're using as the comparable. If their debt to equity ratio is not the same, that can impact the required return to equity, and as a result of that, the PE ratio that you use that you get from your comp firm may not be the right one for your firm. The EV/EBITDA does consider both debt and equity, and so you can use it to value the firm with different debt structures. Even better, you can use it to value based on your EBITDA, and then it will allow you to adjust the value of equity depending on how much debt financing you decide you're going to take. And so, as an example, again, you can solve for the value of equity by subtracting the amount of debt from the EV. In our example, we coupled with an enterprise value of 66.23 million. Well, if we decided we're going to finance the firm with 20 million in debt, then we solve by just taking 66 minus 20, say the equity value must be 46.23. If we wanted 30 million in debt, we'd just say, okay, well, then the equity value can only be 36.23. So it's a bit more robust measure. It takes a little bit longer. That's kind of an issue. The ratios are useful when firms are truly comparable, but not if you ignore some of the important differences. They assume that the current prices of stock in the market are reasonable. So if you're in the middle of a bubble and all of the stocks are, by everybody's opinion, overvalued, and you do these comps based on the market values, then what you come up with is going to be an overvalued price for your firm A. Now, in a market where everything's overvalued, if it's similar to those other things, that may represent a price you could actually get in that market. And in fact, that's how a lot of times whole industries start to become overvalued, is because people rely on these ratios so much, these multiples so much. You also have an issue, as I said before. Should I use the current market price, average over some period? Should it be the average over the last year, the last month, last week, in terms of the price or the enterprise value, if you want the value of the market cap and the value of debt? Some insights though. If we were to rearrange the terms of the discounted earnings model that we reviewed earlier, we would find that you can actually get the PE ratio and from that model, just because it's just price over earnings per share, and when you solve for that, what you find out is it's just 1 over the um, rate of return minus the growth rate. So what that means is that your PE ratio is higher for firms that have either a lower required return, and so usually those are firms with lower betas, less risk, or a higher growth. And so since your value that you think of, or the price that you think of for your stock, is whatever your earnings are times that PE multiple, having a higher PE multiple means you have a higher price. So that suggests that stock prices are higher when you have either lower or higher growth. And that must mean that investors prefer the lower risk or the higher growth. And both of those are consistent with what we found with the discounted earnings model, and they make sense. As we talked about before, the EV EBITDA, we like that even better than the PE multiple. The bigger challenge that most people have is that the derivation to get to, what does that ratio really mean is a little bit less direct. It's a little bit harder to understand than the PE ratio. But actually, the intuition behind it's very similar. It's still 1 over a cost of capital minus a growth rate. The big difference here is that cost of capital has to be your weighted average cost of capital. Sorry about that. It can't just be the cost of capital for equity. It has to be both equity and debt. It has to be weighted. And so it's the overall cost of capital minus the growth rate. But again, same intuition. A lower cost of capital results in a higher price. Higher growth results in a higher price. All the same things hold. So I know we kind of went over this much quicker than the others. The comparables seem to be a little bit more intuitive for people, and they are just an extension of the other approaches. So hopefully this is useful for you.